G'day everyone and welcome to this Share Cafe Hidden Gems webinar. Now today we are discussing software as a service, oil and gas, and then we'll discuss the Pfizer takeover for ResApp. Unfortunately, Zelira are late scratching due to personal reasons our presenter had to deal with, so they won't be presenting today. Just 3 companies on board. Now just quickly from a market perspective and something we spotted today, so behind the market volatility and the red ink, one of the things we noticed was the movement in US mortgage rates, which had their biggest move this week since 1987. I do remember 1987. Now, the average rate on a 30-year fixed rate mortgage rose to 5.78% over the week, according to mortgage finance giant Freddie Mac. That's the highest level since November 2008 and well above the 3.1% mortgage rate recorded near the start of the year. Now, that's a number that will terrify Australian consumers. So the sudden rate rises will have and are having an immediate impact on the US consumer. And that will have further ramifications for the Australian consumer, I'm sorry to say. Now, on that cheerful note, let's make a start. So if you have any questions, please type them in the box provided. First up, we have Knosys, ASX code KNO, market cap around 15.5 million. We have with us John Thompson, who is the managing director. The company is a leading knowledge management software company based in Melbourne and servicing Australia, New Zealand, Singapore, and the Asian Pacific region. John, over to you. Thank you.
Thanks very much, Tim. It's a pleasure to be here today at Share Cafe's Hidden Gem to present Knosys to the audience. Next slide, thanks. So with regards to Knosys, it's very important to have, I think, a very clear mission statement. And ours is that we deliver solutions that empower businesses of all sizes, from large enterprises to small companies, to make smarter connections with their information and knowledge assets. We do this through a portfolio of SaaS solutions that we offer to the market across the world. Next slide, please. So now Knosys is a global company. I want to just really point that out. We have a presence in 5 countries. However, we derive most of our revenue from Australia, the US, and the EU. We've got approximately 353 customers across the globe and over 380,000 licensed users of our technology. And from a company point of view, we have approximately 67 staff members, and those people are spread across the globe, and 20 of those members are dedicated to R&D and product development. Next slide, please. As I mentioned, Knosys has a portfolio of SaaS solutions. Our first solution is our Knowledge IQ product, which is our knowledge management solution for contact centers, support desks, and businesses with branch offices. It's primarily designed to help people, particularly agents, company staff, to engage with their end customers in delivering the right information, following the right processes, and really creating a very well-managed, thought through engagement with their end customers. The second solution we have is our Green Orbit intranet solution, which is fundamentally an internally focused solution on an organization's people. And as you can imagine, in today's world, during COVID and post-COVID, organizations had to come up with means of communicating, collaborating, and providing an engaging sort of workplace for their employees. And this really helped to maintain productivity, not only during COVID, but as we sit here today. The third solution we've got is our library management system. So it's primarily designed to enable libraries, staff to conduct transactions with their end customers. It's also there to enable members of those library facilities to access information remotely in a really engaging, user-friendly way for that. So as you can see, we've got 3 solutions that make up our portfolio. Next slide, please. So one of the important things is, what's the driver for these solutions? It's pretty simple. The first is the increase in remote workers. Now, this started before COVID. It was accelerated during COVID. And as we sit here today, it still exists where a lot of companies are implementing a hybrid work model. The second driver really is for customers. Organizations' customers expect consistency when they're contacting the business. Now, they may contact them through their contact center. They may contact them through their digital channels, such as their websites, using their mobile phones, using a chatbot. An organization has to make sure that the information provided through all the channels is consistent, accurate from that point of view. The third driver is governance and compliance. Now, this is especially important in organizations that operate in highly regulated environments. These organizations need to be able to track and trace all information used in interactions with their end customers in order to comply with the requirements for their particular industry that they exist within. And then the final one really is content explosion and information overload. As we all know, we're generating a lot of information these days and have been for well over the past 2 decades. So what our solutions do is provide a very targeted view of information to the company's end customers and to their employees. We like to think of it as a magnifying glass approach, where an employee only gets to see the information, or a customer gets to see the information that is relevant to him. And that's a common theme across all 3 of our portfolio solutions. Next slide, please. So this slide really generates or shows you a view of our customers and the diverse range of customers that we have within the organization. As you can see, we have some really well-known brands amongst the customer base, but in terms of a split between enterprise customers and mid-market customers, we currently generate 13% of our revenue is derived from enterprise customers, and 87% of our revenue is from mid-market. So as you can see, we've got a good split between enterprise and mid-market customers. Now, the solutions have a very broad appeal across many industry segments, but the main segments, as you can see from the bar graph, are government, which is a very big part of our business, professional service organizations, financial services, and we're really seeing a growth in the health sector in terms of our products and solutions. Next slide, please. So we are a SaaS business, as Tim mentioned. So the key metric that we look for is our growth in our recurring revenue. As you can see from the bar graph on the right-hand side, we have very consistently kept growing our recurring revenue, both organically and through the acquisition. So we've gone from 3 million just on 2 years ago, a year and a half ago, to over 9 million in recurring revenue for the business. In terms of where we're doing from a gross margin point of view, as a SaaS company, our average is about 88% gross margin, which is expected in a SaaS environment where we're running a lot of our corporate services, if that be finance, sales and marketing, support, are common across all the solutions. And that's how we keep generating that very good gross margin. In terms of our churn, it's quite low, it's less than 6%, and predominantly that comes from the mid-market customers, which are the smaller valued customers within our portfolio. If we can have the next slide, please. So this slide, I really wanted to talk about, well, what's our growth strategy for the business? As you can see, we are targeting to grow our customers in the next 2 years to over 1,000 customers, and we want to increase our licensed users from its 380,000 somewhere towards the 1 million mark. And we're going to do this through obviously an investment in a lot of resources that are directed towards sales and marketing, and I'll talk more about this on the next slide. Next slide, please. So in order to achieve these strategic goals, we really have a 5-pillar approach. The first one is to grow revenue from the existing customers, And we have seen this not only in our core business of knowledge management, but through our Green Orbit intranet business and through our Libero library services business. And what I mean by that is we're extracting more value from that existing customer base through a process of upgrades, through a process of increased license numbers. Over the next financial year, we're really going to focus on pillars 2, 3, and 4. The first one is to grow new customers. You've probably seen recent announcements where we've had a lot of success in government for knowledge management. We intend to replicate that success for Green Orbit this financial year and start seeing that happen with Libero as we go forward. We're also in the process of investing in growing our brand. It's very important. That helps us win new customers. It also opens up opportunities for our solutions across the broader customer base. We're also, as a software company and a SaaS provider, we invest heavily into product development because we need to keep the solution relevant and we need to make sure that the solutions are attractive to the customer base. And the fifth pillar to our strategic growth is going to be acquisitions. Now, our focus over the next 12, 18 months is to grow the existing portfolio of solutions organically, but we always keep an eye out for acquisition opportunities that may help accelerate our growth in an important sector that we're currently within. So in summary, I think it's important to understand our growth strategy is funded through our cash reserves of about $3 million and plus our ongoing cash flow from our customer base. So we're well funded to implement our growth strategy over the next couple of years. So altogether, we have a fantastic portfolio of information solutions. There's currently a large demand in the market, and we're fully funded to continue strong organic growth within those market segments. So thank you very much for listening in to the presentation. Over to you, Tim.
Great, thanks, John. We've got quite a few questions, actually. Can you talk through, there's obviously been a lot of volatility in the equity market recently, and particularly from a tech perspective. Are you seeing any impact of that on your ability to sell to your clients?
No, we've been very fortunate during COVID and post-COVID. We've actually seen an acceleration in particularly knowledge management. In the last 6 months, there's been a lot of tenders. We've been fortunate enough to win the majority of those tenders in Australia. And we're also seeing customers who held off buy decisions in Green Orbit starting to reactivate those projects. So the volatility hasn't impacted our existing customer base or our new customers at the moment.
And the government tender process, I assume you're talking about, I assume there's a kind of a long timeline to that, but I would have thought that the government contracts would be very valuable. Can you talk through that sort of client base?
Yes, I mean, the government contracts, unlike some SaaS solutions in other areas of functionality, ours we generally contract for 3 years with extensions of 2 years is a general form of the government contracts. So they're generally, long-term contracts, which is really good for our prediction of our recurring revenue, and it's a good stable base of revenue coming into the business.
And what's that sales process look like outside of the government tenders? I think Kathmandu or a client there. How do you work through that sales process?
Yes, I mean, knowledge management generally, because of its value, is through tendering process more often than not. With regards to, for example, Green Orbit, Kathmandu is a customer of that. These are generally done by proposals. So, we get it, the customer gets in touch with us, or we're in touch with them through outreach or through digital marketing. We do demonstrations, and then we present a proposal, and then we negotiate proposals. So the sales cycles for Green Orbit intranet, for example, are probably somewhere around 3 months from initial engagement to hopefully you sign a contract with the customer. And once again, we're trying to, with Green Orbit, implement very similar to knowledge management, where we have a 3-year initial engagement as opposed to 12 monthly. And that, once again, supports our business operations and plans.
And I mean, they're very impressive margins, of course. From an M&A perspective, what are you looking for? And I know you've made kind of 2 acquisitions. What sort of synergies does that bring to the business?
Yeah, because we implement a shared services model, all of these solutions are just solutions. They're not individual businesses or divisions per se. So we're able to have common sales, marketing, support, things like this. So in terms of acquisitions, potential future acquisitions, ones that would be attractive to us are ones that are within an existing portfolio solution. So it might be, for an example, it could be another intranet solution which is more Microsoft based, as an example. Within knowledge management, our knowledge management system is very capable, but it may be a simple help desk tool that we may be interested in. But it'll all be within one of the existing solutions target markets as such. So we're not looking to add a fourth type solutions. We're more looking for solutions within the areas that we're currently operating within.
And just finally, John, who are you competing with? Is there any ASX listed companies that you would consider peers?
Look, we have no ASX listed companies that are peers. Most of our competition in the enterprise space comes from US companies. Verint and Highland are the main ones we come across at the enterprise level and government level. And then with regards to sort of our mid-market, it's more individual private companies that we come against.
Great, John. That's all we have time for. Have a nice weekend. We'll follow your story with interest.
Thanks very much, Tim.
Okay, next up we have Whitebark Energy, ASX code WBE, market cap of around $11.5 million. We have with us the interim CEO, Simon Brearley. The company engages in the exploration, development and production of oil and gas properties in Australia and Canada. Simon, over to you. Thank you. Looks like we're looking for Simon. Simon, are you there?
Yeah, I'm here.
Great, thank you. Over to you.
There we are. Sorry, apologies, everyone. Good morning.
Right.
Thank you for joining me and to listen to the story of Whitebark and myself. Could we go to the next slide, please? Oh, sorry, not that one, the one after. Okay, so I'll just give you a bit of background on myself and how I came to be with Whitebark. About 15 months ago, I got a call to do an independent geological review of an asset in Canada called the Wizard Lake Oil and Gas Field, which I did conduct. And at the end of it, they asked me what I thought of it. And my conclusion was that it had been hit by things like COVID, but the field was good, the geology was exciting, and that I really liked the asset. And at that point, the custodians asked me to come in then, if I was so confident, and take the interim CEO position and try and get this company turned around. And so that's what we've spent the last 15 months doing. If we can go to the next slide, please. The first thing that happened was a brand new board was brought in. So all the old management has gone. Everyone here has got about the same length of tenure as me, about 12 to 15 months with the company. And on the next slide, please. We've spent the last year really ticking off all the things that we needed to do in order to relist on the ASX. We were in voluntary suspension following the COVID oil price crash. It has been a process, but the new board has set up the company to relist. I think we relisted on June the 7th last week, and now we're set up for growth. And that's what I want to talk to you about this morning. If we go to the next slide, please. Okay, so just briefly, the asset we've got, it's a single oil and gas field called Wizard Lake. The gas is produced along with the oil, which is quite unusual actually in this area. We've got 3 wells in the field called Rex 1, 2 and 3. Now the channel sand that we're exploiting is about 1,400 meters deep, but the way that the wells are drilled is to go down to the reservoir depth and then kick the well off horizontally. And as we've learned, or as the previous management have learned as they went along, each well has increased in its horizontal length. So Rex 1 was 1,400 meters long and Rex 3 was 2,100 meters long. The field's got about 5 million barrels of 2P reserves. This was from my own evaluation, which is on the website. And above and beyond the 3 wells that exist, we've got 20 additional drilling locations which have been identified to exploit those 2P reserves. Next slide, please. So the immediate development potential, and this is so exciting for me as a geologist. I've never done this sort of management stuff before, but to be a week after relisting and now in a position where I'm contracting a rig to drill the next well, Rex 4, which will be drilled to the north of the existing well pad. And I should point out at this point that the existing infrastructure we've got there, the wellhead and well pad, can accommodate another 5 wells. So that's Rex 4 through to 8. Rex 4 and 5 are already fully permitted without any further infrastructure investment required. So the plan for Rex 4 and for future wells is to go a little bit further than we've done before. We're aiming for a 2,400 meter horizontal section in the well and a 50-stage hydraulic fracture stimulation on completion. So we're adopting a fairly cautious approach. We want to get that wellbore drilled and prove that the entire wellbore is in oil-saturated reservoir before committing to the completion and fracture program. Next slide, please. It's a bit busy, apologies. The ultimate recoverable assumed from a new well with that kind of completion is about 150,000 barrels of oil and about a BCF of gas, or a million cubic feet. So these wells come on, the reservoir is quite good quality, which inherently means that the reservoirs come on, or the wells will come on at quite a good initial rate, but that rate does decline quite rapidly. So the initial production that we've modeled based on the history of Rex 3 and the other wells is about 300 barrels of oil a day and about 1.4 million cubic feet of gas. That does decline month by month, but the well life itself is about 11 years. So what you can see on the bottom chart on the right there is our production forecast. Now this assumes that, as I say, we're contracting a rig. It's currently moving to site to drill Rex 4. The cash flow generated from that, which is on the top chart, means that we'll be able to self-fund the next well, Rex 5, from self-generated cash within about 6 months. Obviously, this is an ongoing venture, and I want to be in a position in 12 months where I'm drilling at least 2 to 3 wells a year, all from self-generated funds. And the next slide, please. Okay, so this is just up the road. There's our nearest neighbour, actually, 15 kilometres away. CALIMA Energy have been drilling wells. The most recent one's called Leo 1, 2, and 3. But this is, I like this analogy because they've adopted exactly the same completion strategy that we are going to use for Rex 4 onwards. So additional horizontal length, more frac stages, and letting the wells heal naturally rather than pulling on them as hard as we can. So CALIMA's own, and there's a reference there to their website, CALIMA's own economics say that a well completed in this way has got an NPV $6.5 to $9 million, depending on the commodity price that you use. Next slide, please. Obviously, there's your price forecast. So commodity prices very strong at the moment. I do the economics based on $85 oil and $4 gas. So everyone keeps telling me I'm being too conservative, which is the only time in my life anyone's ever told me that. But I think that's the final slide. Is there one more? Okay, yeah. So also in Western Australia, we have an asset called the WARRO gas field. Now, this is a large, tight gas reservoir. We are looking at ways to create value for the company from that. It's not something that fits with our core strategy right at the moment, but with strengthening commodity prices, there's been a very big increase in activity in the Perth Basin, and we're talking to several parties about how we can possibly create value from this asset. And that, I think, is the end of my presentation. Thank you very much for joining me.
Thanks, Simon. Thanks for your time. We actually know the CALIMA story pretty well because they've been on the webinar before. Can you talk us through what's going on in the industry in general at the moment? Just because of A, where the oil price is, B, you've obviously funding is potentially difficult now. You've got kind of ESG mandates from a lot of institutions. Can you just talk through the general industry? I read today one of the shale companies was considering going private because there's not a lot of support from the private markets. So did you from the public market? So did you have a view on that?
I don't really have a strong view, but what I will say is that we obviously, with the commodity prices where they are, the industry, businesses within the industry, such as Whitebark, we're doing well. You know, we're doing a lot better than we were 12 months ago. It means that more marginal features are definitely commercial. And we're looking at expansion through asset acquisition in Canada with neighbouring assets that we can bring the same operations based and experience based to bear on. In terms of the market, I don't know. I mean, today's been a funny day. I wouldn't have predicted it, and I can't explain it. But I do think that oil and gas is you know, it's definitely a place that there's definitely a place for it in a portfolio, because it's just going to get bigger.
Yeah, well, it certainly seems an area where there's a lot of cash flow, and certainly that will attract investors in the long run. So in terms of cash flow, can you talk through, you mentioned kind of self-funding future development from existing cash flows. So can you talk through the kind of economics of how that looks?
I can. So the current production, the existing wells, Rex 1 to 3, they're doing about 50 barrels a day and about 800,000 cubic feet of gas a day. It's about 120 barrels of oil equivalent per day. And that generates for us a net operating income of about 200,000 Canadian per month. Now, the incremental difference that drilling Rex 4 will make, because of its initial high production rates, is that will add about 700,000 a month. So it'll take our monthly net operating income from 200 to 900,000 over time. And this is using my modest $85 oil scenario. It generates over $4 million Canadian in the first 12 months. And that's enough to pay for Rex 5 through self-generated cash. Obviously, it's a stepwise process. Once we've got Rex 4 in the ground and we can fund Rex 5, then, you know, in half the time we can fund Rex 6 from the self-generated cash flow.
And you've got some this question here. Well, this maybe you could give us a little bit more color on what is the kind of capex requirement for Rex 3, Rex 4, and Rex 5. And you've also got some options that are expiring. So can you give us a bit more color on the options as a potential source of funding, I suppose?
I wouldn't actually find myself qualified to comment on that, Tim.
Sure, no problem.
I can certainly talk about the capex requirements for the wells. So Rex 3 is on production. That doesn't require any further capex. The capex for drilling Rex 4, and bear in mind that since oil prices have strengthened, obviously service companies are charging more for their services. So it's actually about $4 million Australian to drill Rex 4. Sorry, that's not right. It's about $2 million to drill Rex 4, and assuming that we have success, it's a further $2 million to complete it with the frac stages that we want to do. I wish I could give you more colour on the options. I'm just not educated in that field.
That's okay. We can have a look at that and pass that information on. What about the where the gas is produced? And is it a domestic market, the sales market, or is it international?
It is. So we're lucky that we've got the company previously constructed the infrastructure to export gas directly from a pipeline from the wellhead. So the gas goes to a processing company called Petrus. They take out the natural gas liquids, which are selling for $78 a barrel at the moment. And then the gas itself goes to BP, our ultimate customer. The oil is trucked to an intermediary called Tidal, and they sell the oil at market price on an average over a given month. But the Canadian gas market at the moment is very strong. As I said, I'm using a forecast of $4, and it's been over $8 in the last few weeks.
Always good to be conservative, we find, these geologists. Now, a final question before we go. Can you give us a kind of a timeline of how you're working?
Absolutely. So look, the rig, it's fantastic. I've worked in the North Sea in Australia, and it takes you a year to get a rig. In Canada, they just say, what day do you want it? So the rig's ready to move. Unfortunately, unbelievably, it's raining very hard, and they can't move it because of the wet ground. But we're ready to go in the next week or so. I would say that we're going to have the lease dried out, the rig on site. The Rex 4 will take about 12 days to drill the horizontal section. Then we'll determine that the wellbore sits in oil-saturated reservoir and seek to complete the well. I would like to think that we can get it on production by the end of August. The wells do take a few weeks to clean up, they call it. But yeah, I'd hope to have it on production by the end of August. And then that means that we can self-fund the drilling of Rex 5 before the spring melt in January 2023.
It's certainly a very short time frame. So thanks for your time. Thanks for your time, Simon, and we'll get you on again.
Thanks, Tim. Bye.
Thank you. Next up, we have ResApp, ASX code RAP, market cap of 146 million. We have, of course, had the company on before. The stock is up an incredible 270%. We have with us Tony Keating, who is the CEO and Managing Director. The company is developing digital healthcare solutions to assist doctors and empower patients to diagnose and manage respiratory disease. And of course, the company is subject at the moment to a takeover by Pfizer, which we can discuss. Tony, over to you. Thank you.
Right. Well, thanks, Tim. And welcome everybody again. And again, it's a pleasure to again present here at Share Cafe. What I'd like to go through initially is a very short presentation deck. I know I've presented here, I think it was a month or so ago. So I'm not going to give a long presentation, but just give a short presentation, a little bit of background about ResApp, some background about the transaction, but really give the opportunity for you all to ask questions. We realize this is a time where there's a major change in ResApp, and we're very open to answering questions from shareholders. So next slide, please. And next again. So as a bit of a background about ResApp, for those who haven't heard the story before, ResApp uses sound to diagnose respiratory disease. So we spun out of the University of Queensland roughly 7 years ago now, based on technology developed by Professor Udantharabaratne at the university. And his idea was, could we use cough sounds to look inside the lungs and diagnose different diseases such as pneumonia or asthma or COPD? His work was funded by the Bill and Melinda Gates Foundation. And what the Gates Foundation were looking for was really a low-cost tool to diagnose pneumonia in the developing world. Pneumonia is one of the biggest killers of children under 5 in the developing world. About 1 million children every year die from pneumonia. And so that's where the initial technology came from. Since spinning the company out of the university, we've run numerous clinical trials. We've had peer-reviewed publications. We have regulatory approvals of our technology that just uses cough sounds to diagnose disease. It's really as simple as coughing close to a smartphone. Smartphone records that cough sounds. We then use artificial intelligence, or more correctly, machine learning technology, to analyze those cough sounds, look for signatures that are associated with different respiratory diseases, and provide a diagnosis. So we've done everything from pneumonia through asthma, through COPD, and just earlier this year in March, we released our preliminary results around COVID-19. And so again, we're able to use cough sounds to identify COVID-19 at a roughly 92% sensitivity and around 80% specificity. So this gives us a really strong option of taking to market a COVID-19 screening tool, which could have large implications or a large effect on the management of COVID-19 moving forward. So next slide, please. So when we released the COVID results earlier this year, we were also having discussions with Pfizer. Pfizer at that time then decided to make an offer for the company. They made an offer at 11.5 cents when our share price was roughly 9 cents. Since that time, we had an independent expert report come out. That draft independent expert report said that our share price was more fairly valued at a range of 14.6 to 27.7 cents, with a preferred value of 20.7 cents. And so based on that, the board went back and negotiated with Pfizer to get a higher offer. And just earlier this week, Pfizer submitted a revised offer that brought that range up into that independent expert range. And so right now, the revised deal structure is actually a 2-tiered price structure. So what we're doing at the moment is running a confirmatory data analysis study. So we've continued recruiting patients in our COVID-19 study since March. We now have a fairly substantial data set of roughly 300 positive patients and over 1,000 negative patients. We now will analyze that data. If that data performs within some agreed thresholds that we agreed with Pfizer, then Pfizer's offer will be at 20.7 cents. So that preferred value of the independent expert, and importantly, a 130% premium to the share price prior to us announcing this scheme. So 130% higher than that 9 cents to get up to the 20.7 cents. If, however, the data falls outside those thresholds, then Pfizer will raise their offer to 14.6, which, as you can see, is the lower bound of the independent expert report. But this also represents a 60% premium to the share price before we started. And, it's still a substantial increase over where we were before with the prior offer of 11.5 cents. So in general, what we've seen here is Pfizer, making a significant increase to the offer, and the board is very happy to recommend that to shareholders. Next slide, please. So as I just mentioned, the next steps in this deal are we're performing this confirmatory study, 1,300 participants. We're expecting those results, in the next few days, and we're excited to see those results. Look, and I think it's important to realize that pilot study that we presented results in back in March was very encouraging. But it's also important to note that those results were cross-fold validation results, which means we were training and testing the algorithms on that data set. It wasn't a true prospective study, which is what we'll see with this confirmatory study. Now, we've always seen very consistent results moving from cross-fold validation into prospective studies. But we need to do that. It's the next step in the development of the technology. The next step for shareholders is that a scheme booklet, which will contain information relating to the scheme, including a copy of the full independent expert report, as well as the reasons for the board's recommendation, the risks that we see going forward, will all be sent out to shareholders in early to mid next month. And just, I guess, as a conclusion, we really recommending that to shareholders to vote in favour of the transaction in the absence of a superior proposal. So next slide, please. And I think Tim would happy to answer some of the many questions that are coming through already.
There are many questions, Tony, but firstly, congratulations. I mean, to have a company like Pfizer validate what you're doing for an Australian company is worthy of congratulations. So that shouldn't be missed out in terms of describing what's happened here. Now, can you? Why is this? There's a question here. Why is this a scheme of arrangement rather than a kind of off-market or simple takeover?
So a scheme of arrangement is typically, I guess, first of all, it's what Pfizer requested. That's what their offer was a scheme of arrangement. A scheme of arrangement gives the other party essentially certainty in the complete takeover of a company, and so their decision to do a scheme of arrangement was their decision, and as I understand it, the main benefit of that, it means you get you don't end up owning a part of the company, you end up owning the whole company, and that's effectively what they want to do.
And how did this kind of revised proposal come about?
So back a month or so ago, the board obviously received the first offer from Pfizer at 11.5 cents. We thought that was a significant premium to the share price back then, which was in the range of 8 to 9 cents. It had been that low for a significant amount of time, roughly a year or so. So we thought that was a good offer that we should take to shareholders and that we should recommend to shareholders, subject to an independent expert report. And that's customary in these sorts of deals that the board will recommend subject to an independent expert report. So we then commissioned the independent expert report. The independent expert report came back at a range that was quite a bit higher than that 11.5 cents. And I think from Pfizer's perspective and really from our perspective, we're a little bit surprised at that, given where we are in the development and the risks associated with in particular taking the COVID algorithm forward. And so, we went back and used that independent expert report to negotiate a better deal for our shareholders with Pfizer. And so that process was then, over the last few weeks, we've been negotiating with Pfizer to get a better deal for our shareholders. We now have what we believe is a great deal for our shareholders based on this tiered structure, and we'll bring that forward now.
And shareholders, of course, Tony, are never happy, even though you've improved the share price by 270%. Why the plan to sell to Pfizer, and what are Pfizer's plans for the product, if you can tell us that?
Yeah, so I mean, I think from why selling to Pfizer? I mean, effectively, we're providing, well, we're recommending this offer because we think it is a good financial outcome for our shareholders. There are, it's a significant premium to where the shares are trading, 130% to where it was when we started. I think that it values the risk in the company. It values both the opportunity in COVID-19, and you'll see that in the independent expert report about the size of the opportunity for COVID-19. But it also takes into consideration the risk associated with taking this technology forward. There are regulatory hurdles, there are clinical hurdles, there are commercial hurdles, and then there's general market condition hurdles. So I think if you consider what ResApp would need to do standalone wise, the amount of capital we would need to raise and take this forward through all of those hurdles versus an all cash offer from someone like Pfizer in the next month, there is a financial incentive there. So that's really where our thinking was. What does Pfizer plan to do with the technology? Look, I think Pfizer has great resources to overcome many of those hurdles and get the products to market. They're the ones that would then take on the risk of doing so, while our shareholders would have a cash in their pockets effectively.
And there's questions here. There's lots of questions here. Is there a chance of competing bids?
Look, there's always a chance of competing bids. Obviously can't comment about any of the discussions that have been going on or are going on. But at this point in time, we don't have a competing bid in the process.
And was the kind of acceptance of the bid based on the fact you have a multinational like Pfizer coming in to be able to commercialize the product?
Look, I mean, I think, from a product development and a technology perspective, someone like Pfizer offers, the technology an opportunity to really get to market quickly, have the resources that's required to get it to market and overcome those hurdles and reach the most people. So, look, I think from an altruistic angle, someone like Pfizer could help us get the technology into the most people's hands and have the a biggest impact on patients' lives. But I think the main reason the board looks at this is trying to provide shareholders with the best return financially and the best risk-adjusted return as well. And I think that's important to note, that we take into account the risks of the company going forward versus the all-cash financial return in the short term.
And are you satisfied that the revised proposal is sufficient? And is it enough to win 75% of the voting majority at a scheme meeting?
Yeah. So look, I mean, the final vote is up to shareholders, and that's how this works. And the future of the company is essentially in the hands of shareholders and that vote. Look, we think that we've worked very hard to negotiate a very strong and compelling deal from Pfizer. We strongly recommend that shareholders vote in favour of the scheme based on our knowledge of the risks going forward and knowledge of the offer. But again, this is a shareholder decision in the end, and it will come down to the shareholder vote.
And on that, what are the benefits of the transaction versus kind of the risks if the transaction doesn't proceed?
Yeah, so I guess the benefits, the big benefit of the transaction is, it's an all-cash offer from Pfizer, which would see a decent premium to where the share price was trading over the last 18 months. And so, that's the primary benefit for shareholders. The risks if the transaction doesn't proceed, well, I mean, I think, as I mentioned just before, we will probably need to raise a significant amount of capital to take this technology forward, to, move through those hurdles. So whether they're additional clinical trials, whether they're regulatory barriers with FDA, whether they're commercial barriers of getting the technology out there. So there will be significant amount of spend and risk associated with going through that. I mean, I think and saying that we would need to raise a significant amount of capital in the current environment is also important to realise. The current environment is not friendly for capital raising, is not friendly for biotechs at the moment. So there is that pathway does have a fair bit of risk, and it's a risk reward balance that shareholders need to consider and work out which way they believe they should turn. And I think the board's recommendation looking at this is that 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 pro of getting immediate return for your cash is probably is a good option to consider at this point.
And so outside of this question here, Tony, outside of the Pfizer takeover, has there been any other developments or work progressing, licensing deals, submission for regulatory approval for COVID screening, etc.?
So, as I said, the next step in COVID screening is this prospective study that we're running, with Pfizer and these results and this confirmatory data readout. So that was the next plan for our COVID technology. We certainly didn't have data that we could submit for regulatory approval based on those March results that we released. So this is the next stage in the COVID development, was this data readout. The rest of the business is just moving on as normal. Our sleep check FDA submission, is expected, or I guess a decision is expected this month, which is what we've communicated to the market previously. We have other business development discussions in telehealth with ResApp DX. We obviously have revenue flowing from AlloDoctor, from Medgate, from our customers. So outside of the Pfizer acquisition, it's business as usual for the rest of the company.
And Tony, there's a lot more questions here. What I'll do is I'll end it here and I'll forward those questions through to you, and we can manage it probably better that way.
Yep, absolutely.
So thanks for your time and have a nice weekend. Congratulations on the Pfizer deal.
Great. Thanks, Tim.
Great. That's all we have time for today. Thanks for your time. Apologies for Zelira. We'll be back again next week. See you later.